Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about CrowdStrike. CrowdStrike reported its Q4 2022 last night. Results were strong, guidance is strong. It's kind of gonna put us a floor on the share price. I think that it's quite interesting to see that right now the market is trying to discern through what was previously just one trade. You kind of bought cybersecurity stocks and everything just traded together. Right now, it appears that for the first time in a long while, it actually makes a lot of difference to put in the work and figure out what's worthwhile investing and what's not, and it's going to pay dividends down the road. So yeah, there's a lot to get through here, but the takeaway here is that this is a very attractive investment right now. Got a lot to get through today, so let's just kind of press forward. I've kind of highlighted a few names here, okay? These are cybersecurity names, and what I want to highlight, I know it looks a bit fuzzy, the graph, but what I want to highlight is the discrepancy between things that were growing fast and expensively valued compared to things that were cheaply valued, okay? And it's so at the top of the graph you got Palo Alto and you got Mandiant, and even before Mandiant's rumored acquisition by Microsoft, which ultimately turned out to be Alphabet. Even before that, it was really holding its value a lot more because, had a strong balance sheet, a lot of cash on its balance sheet, was talking about repurchasing its shares. So this is my point here. Nobody was really thinking in the back end of 2020 into 2021, what the cybersecurity company was, what the prospects that people were paying up for. It was just like one trade, didn't matter about revenue growth rates, margins, narratives, nothing mattered. It was just one trade. But when the shares all started falling at the end of November, everyone was starting to think, okay, what is actually worthwhile paying up for and what is not? And it's interesting because back in back in December, I said, okay, I talked about CrowdStrike in the CrowdStrike article. You can check that for yourself. I wrote Sentinel-1, which was already priced at 39 times forward sales, and Sentinel-1 is growing really, really fast into next year, but that Sentinel-1 wouldn't know a profit if it found one on the street. Its most recent results saw negative 40% non-GAAP operating margins. So you obviously know all about non-GAAP operating margins and how on an actual, how much stock-based compensation goes into that. But what you can see here is even over a period of 90 days, when I made that previous statement, there's a large discrepancy. So including the 15% pop on CrowdStrike's shares, the discrepancy between Sentinel-1 and CrowdStrike is approximately 20% outperformance even in the 90-day period. So this is my thesis here. It makes a lot of difference if a person's thinking a little bit about valuations. If it doesn't matter, and it's just, you invest now and then in 10 years you see how it works out, then fine. But if it makes sense thinking about valuation where you're trying to get the best return, then the market is very much moving towards higher values. This can be businesses that are growing slightly slower, much more profitable, or businesses like CrowdStrike. Yes, you got a nice balance of growth and profitability, but they're not really much in the bargain basement. So as you would think here, the guidance for 2023 is really, really strong. They're pointing towards kind of nearly 50% year-over-year growth rates, And what's interesting is that CrowdStrike is going to be on a run rate of more than 2 billion in revenues by the end of this fiscal year. So for them to be growing at 2 billion in revenues on a run rate and to be growing at 50% is really, really strong. They're just persistently growing really, really strong for a really, really long time. And what's quite interesting here, so note that Q1 23 is pointed to be up 54% year over year, okay? But the guidance for the rest of the year doesn't meaningfully decelerate. That's the first thing. And secondly, that Q1 has the toughest comp against Q1 of the previous year. So if they can grow at 54% or even slightly higher, because they're probably lowballing this, 54% for Q1, which is the toughest quarter for them to overcome, the rest of the year is just going to be really strong for them. And you can see here, so analysts were kind of expecting, for the later parts of fiscal 23 to be up just in the mid 30s. So I think that they're just going to smash through this. I think that it's a very interesting setup for investors right now. So what CrowdStrike does is a cloud-native platform that stops data breaches. It's about detecting threats and stopping the breaches. And what's particularly interesting right now was that during the earnings call, they talked about how partnering up with Amazon has led to a sourcing ground for new customers. We also hear about, as you would expect, that CrowdStrike is making a move towards identity protection, and also, the backdrop of the Russian invasion of Ukraine, how cybersecurity is really the fifth dimension in this kind of warfare. So you'd kind of expect that, everyone's kind of looking at this cybersecurity names so much in the news in the last several days. You'd expect that. It was interesting to hear how them talk about that Mandiant's acquisition by Alphabet hasn't really dampened CrowdStrike's partnership with Mandiant, because they believe that Mandiant will be much more used internally for preempting breaches, and this doesn't dampen CrowdStrike's ability to service Mandiant as to service Alphabet as a partner. So it's a very strong earnings result for the company. It's also, if you followed my work before, you've noticed me saying follow the customer. That's what you need to be focused on. Okay, if in the case of CrowdStrike, 65 out of the 100, the Fortune 100 companies adopt CrowdStrike, it tells you something, right? These companies have the technological requirements and the money to pay for the best of the best cybersecurity platform. So if they are adopting CrowdStrike, that tells you everything you need to know. They're doing the research for you. You can see there the customer growth rate is really, really fast, just up 65% year over year. So however you look at it, from many different angles, I think that this is a compelling investment. The one thing that I wanted to highlight is that while non-GAAP operating margins are up from in fiscal 21, they were a positive 7% non-GAAP. For fiscal 22, jumped to 14%. The guidance for fiscal 23 is pointed to approximately 14% too. So we're not seeing them dramatically increasing the path to profitability once you account for the stock-based compensation. But I think the market is going to give them a wide pass here because they're just growing so fast. And once you're growing at close to 2 billion in revenues, it gives you the quality of a quote-unquote blue chip company. And for you to be growing as a blue chip company at 50%, I mean, I think the market's like, yeah, whatever. Do whatever you need to do. You've already proved yourself. Continue just growing. What else did I put out here? Yeah, basically, as I look at it, right, the share price has really, the multiple has really compressed. It was priced at approximately 48 at its high, 48 forward sales, and it's come down. The graph hasn't updated for the new guidance, but it's come down to 18 times forward sales. So it's just really, I never could think that the multiple could compress so quickly in 3 months. It's gone like just like that in 3 months, and I think it's tough for investors. But for new investors coming in, this is a very attractive risk reward. Everything is like in the bargain basement here in terms of strong growth, path to profitability being very much on the cusp, including stock-based compensation. The multiple is low. Strong adoption by customers. I mean, everything that you can think of is really, really strong here. Just for not to pick on Sentinel-1, but they are going to report their results next week. But if you look at analyst expectations, they're going to grow to the consensus is for them to have fiscal 23 of approximately 350 million in revenues. So 350 million in revenues for next year, and that puts the stock price at 26 times forward sales. So even then, in that event, it's meaningfully more expensive. However you want to cut it, even though it's come down quite significantly, it's still really, really expensively priced. And what I like about investing is that you're always being humbled, right? So you're never as good as your portfolio, and you're never as bad as your portfolio is when it's in the trash. And it's when you're down, obviously it's much more painful than when you're up, but it's kind of an interesting time to be an investor. If you want to know, I'm actually moving my capital towards areas that I find more compelling in the market than cybersecurity. I'm just moving around to that. I think that the risk reward there is even more favorable, and if you want to find out that, don't forget to check out my marketplace. Okay, it's called Deep Value Returns. Thank you so much for listening, and I'll see you soon. Bye bye.